Welcome to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. Today is February 6th, 2026. This is episode 222. And AJ, I went with the red background because I feel like the people need your advice this week. I'm hearing a lot of bear market activity. I'm seeing a lot of red, a lot of negative percentages. How you doing? How you feeling? Are you manning through the storm? The people need you today.
Yeah, I'm doing fine through the storm. As you know, I'm selling premium. So those folks who are totally stocking up on options as a form of hedge for their portfolio for their individual trades, I'm the seller. So I'm in a pole position here.
I feel like we have a special guest on here today that will probably get on here earlier on the show to help with some of the market commentary. But before we dig into that, I'm very curious of where we're at in your rainbow analysis
hmm
because over the past couple of weeks, we've kind of been laying out some levels and we're like, we need you to pay attention to these levels.
Yep.
And we feel like just the past couple of days, we hit a lot of important critical levels. And
Yep.
I'm really curious to see what your take is.
Yeah, let me zoom in and because it's been topsy-turvy. I don't know a better way to say it besides that. Let me overlay some of our drawings that we like to look at. So there has been some critical levels. So the first level that I want to talk about is the top. Last time we were talking, we were wondering whether or not on January 27th we would get a top. And that January 27th close, right? We closed at 6,978 and 60 cents, was ever so slightly higher than the previous close, which was 6,977.27. So basically the same, but when it's slightly higher, what that meant is it signaled another trend change for us. So we had just gotten a trend change. These dotted lines represent trend changes, and when the dotted lines get their support and resistance lines, the light blue lines, it means that the trend has matured. So what do we see here? This trend never matured before we got our new trend started. So all well and good. Now, fast forward from that top that barely was a higher top than the previous top. Now we're wondering, are we going to get a bottom that's below this previous bottom? So this previous bottom, $6,796.86. This one over here, the one from yesterday's close, $6,798.40. So literally like $1.50, $1.54 change, something like that. And so we're ever so slightly above that line. If we go below that line, what that triggers is yet another trend change before the trend gets mature. So topsy-turvy, trend changes, moves from top to bottom lasting less than a week. This is all signs of a very confused, very uncertain market. Implied volatilities are high. What is implied volatility? Implied volatility means anxiety. Anxiety is high, not knowing where to put your money. We're seeing a huge sector rotation, those top 10 stocks that have been ruling for like the last 3 years. We're seeing money leave those stocks and go into value plays. Value plays are plays that are companies that are making money. They're not just on hype. They're actually, their valuation completely explains their business model. Those companies, by the way, would benefit the most from an interest rate drop. So, with the employment numbers, all these things that have happened this week that have gotten people up in arms, money is flowing into these value plays in order to profit from that in the future. Money's flowing out of speculative plays. The AI bubble seems to start to be eroding. People have been talking about the bust, about not a matter of if, but more of when, and will it be dramatic or will it be ever so slightly bleed off? So we're starting to see hints of that this week.
Yes, and the news headlines are definitely picking it up, and certain asset classes are moving a little bit more than others, and they're hitting the news cycle. But I guess since we got your initial take, maybe we could bring our guests on to kind of help discuss where we are with the current markets. And so it's nice to have our good friend Jeff Tompkins back from Altos Trading. Good morning, Jeff. How you doing?
Hey, good morning. Great to be here.
So Jeff, wild week for you from what you're seeing and some of the people that you've been talking to. What's your take with what you're seeing with this pullback so far this week?
Well, I think there's going to be, I think volatility is here to stay for a while. Of course, we're entering a seasonally wise, one of the most bearish months of the year. And I think when you put that in context of where markets are in terms of being overextended to the upside, I think that not to mention we're overdue for a correction, right? We on average tend to get 2 to 3 corrections per year. We really haven't had one since the April lows last year. So yeah, we're just overextended. We're seeing a lot of rotation out of tech, as you know, and that rotation, of course, everything was heavily centered in a lot of these mega caps, and so we are seeing some rotation in more breadth in the market. But we're kind of in a risk-off environment, although as we see today, right, we're going back and forth. So I think there's going to be a lot of whipsaws and chop going into February.
I think that I think there's a lot of bargain buying happening today, but I'm not sure how long that's going to last.
Because of the overall potential for the decline for the next couple of weeks as the rotation happens. I see you brought up the VIX, which usually is a good trigger of the validation of any of this, jumping out the window. Are you seeing that from your end, AJ?
Well, yeah. I mean, look, the VIX has been creeping up higher again. Today, there's some bargain buying, which means people are kind of relinquishing their options on their hedges. So you see the VIX dropping, but the VIX is still, starting to work its way up. So talking about that hedging against, anxiety, that implied volatility rush, we're seeing it, Sip.
All right. So then,
Jeff, it's good to see you, by the way.
Good to see you, AJ. Yeah, it's been a while.
Yeah.
Great to be here.
So is this good for options strategies? Because I've been reading, seeing a couple tweets this today. I can bring one up here right now that really kind of touches on that, and that's essentially the storyline that retail investors' activity in the U.S. options market is through the roof. And so does that play into one, AJ? Obviously we're discussing at Trading Trainer. But then I guess, Jeff, you seem to have some strategies around, using options to kind of level off from these pullbacks and this scarcity. So AJ, I guess maybe we'll start with Jeff to get your take on.
I'm very curious. I'm very curious because Jeff, I know you've been on this. You've got a strategy that you've been talking about. I think you did a pretty big webinar just recently. I'm so curious. I'm so glad that you took a moment to join us on our show today to talk about this. Can you give us kind of maybe a 40-second summary of what you're doing here, what kind of the thoughts are?
Yeah, absolutely. So we're focusing on short duration option contracts. And these have, of course, become all the rage, right? Zero DTE is a big thing on the retail side now. So what we're looking for with our golden one-day options trade is to eliminate the need to forecast directional movement. So this is largely centered around using gamma, of course, one of the option Greeks, to our benefit. For those people who are familiar with short duration option contracts, you know that gamma has a major impact on these relative to option contracts that say expire 30 or 60 days out. So there's a lot of gamma risk in short duration contracts, but there's a way to use that to your advantage. And so that's largely what the golden one-day options trade is designed to do. But it's, as I mentioned, designed to eliminate the need to forecast directionally. So this is a great strategy for the current market environment, as we're getting, very violent whipsaws in either direction. One day we're down, the next day we're up. Well, with this strategy, it doesn't matter which way the market goes, and it doesn't matter to what magnitude. It could rally to the upside, or it could tank to the downside. And this unique strategy has the potential to profit in either scenario. And then we're using some really basic but highly critical option statistics to determine this. So we use things like the expected move. And the nice thing about short duration option contracts in 0 DTEs is that for the securities that offer them, we now have daily expected moves. So we have all this information that we didn't, previously have available to us prior to the advent of short duration options. And so we can use that information on a daily basis to get a very reliable idea of where the market is expected to move by the end of the expiration cycle.
That's more than 40 seconds, but I kind of got the idea. Jeff, let me ask you this. Take a step back, and you threw out gamma. So I know a lot of folks, they know delta, right? Delta is the amount of movement for a stock given the underlying symbol move. And theta is, days to expiration. What's our theta decay? And vega is a measure of implied volatility changes and a coefficient for implied volatility changes. Mm-hmm. Explain to us kind of so that even the most neophyte trader could understand gamma.
Sure. So gamma is essentially just the rate of change of the delta. But why it's important, and a lot of people don't realize this. So you mentioned theta. So many people are option sellers, right? They sell option premium. And we've all been kind of trained, it's ingrained in us that the closer you get to expiration, the more the option decays. So we tend to want to sell short duration premium. However, you have to take into consideration gamma. So as you get closer to expiration, and certainly with short duration contracts like 0 DTE or 1 DTE, that gamma risk increases exponentially. So selling 0 DTE option premium is actually very risky unless you really know what you're doing. But essentially what that gamma risk is you get all this open interest stacked up at a strike price, right? And let's say it's a call option. So somebody goes out, a retail trader, you or I, goes out and buys a call option. Well, the market maker has to sell that call option to us. And we know that market makers aren't in the business of taking directional risks. So they will delta neutral hedge, right? When they've sold that call option to a retail call buyer, they will go and buy shares of the underlying stock or ETF or index, whatever it is. And that alone will drive the price of the underlying asset. So people often think it's the other way around. It's the stock that moves the option, but it's largely the option that moves the stock. And that's where gamma comes in, because when you get all this heavy open interest centered around these short duration contracts like 0 DTEs, and you start to approach one of those strike prices, right? The delta changes. So as the gamma changes, the delta changes, and that, for instance, if for a call buyer, right, and the market maker who sold that call, they're hedging by buying shares of the underlying. And as that delta increases, they have to buy more shares. And it creates this feedback loop that has a major impact on the movement of the underlying asset. And so a lot of people aren't aware of this, but that's mainly how gamma affects your trade. And the closer you're to expiration, or the shorter duration the contract, the greater magnitude that has. And so I like to use just a basic example. You take trader A and trader B, right? Trader A does the exact same strategy, same strike prices, same underlying asset, but on a 0 DTE contract. Trader B, same strike prices, same underlying asset, but let's say 30 days out in expiration. They're both exposed to the same movement in the underlying stock, right? But that trade will be impacted in a drastically different way in terms of P&L. So this is what we're using to our advantage in the golden one-day options trade.
The golden one-day options trade. How'd you come up with that name?
Oh, that's a good question. I think maybe I just woke up in the middle of the night and thought of it, but
You're like that. This is golden, right?
it's golden. Yeah,
Jeff,
the
you
name
haven't
implies. Yeah.
you haven't been on our show in a long time. Can you remind people kind of what your experience is? Why are you the person we should be listening to?
Yeah, I can give you a little bit of background. So, I've been in the markets for over 2 decades, about 26 years. Started back in the late 90s. I
Mhm.
did a professional trader internship at Morgan Stanley back in the early 2000s, and launched Altos Trading about 10 years ago. And we've rapidly grown to over 60,000 members in over 100 countries across the globe. And I'm also a hedge fund manager. So I trade on both the retail and the institutional side. So I manage a hedge fund, Altos Capital. And we trade equities, ETFs, options inside the hedge fund. But a lot of what I'll be sharing on the session and what I shared this week on the webinar sessions are more institutional level tactics. So things that I use inside my hedge fund, including the golden 1 day options trade. But yeah, so that's my background. I've
Cool.
been through all the trials and tribulations. Most of us have. I've blown up accounts. It took me well over a decade to really reach a level where I was confident and consistent. So I'm aware of the very steep learning curve surrounding trading, and so my goal is to kind of break down that line between retail trading and institutional trading, and for people who might not necessarily want to become professional traders or trade on the institutional side, but that doesn't mean they can't have institutional level tactics and strategies. So my goal is really to level the playing field there, because I trade on both sides, and I see some of the advantages that aren't available to retail traders on the institutional side.
So this golden 1 day options trade, you keep saying 0 DTE. That's 0 days to expiration, 1 day to expiration. Are you actually opening the position and closing the position on the same day? Or are you carrying it overnight? Tell us more about the actual kind of the trade.
Yeah, good question. So this trade can be done either 0 DTE, 0 days to expiration, or 1 DTE, 1 days to expiration. We don't want to go any further out than that, because we start to lose that advantage
Gamma.
of gamma, right? So it can be either or. Most of the time, we enter and close these in the same trading session.
Okay.
Yeah.
Neat. Well, tell us more. Tell us what we should know, or what where do we find these candidates? What are we looking for? Anything you want to tell us about this that you can share without us. I realize you're only, this is probably like a master class that requires a 90-minute or even more
Yeah.
session just to get the ideas. But can you whet our palates any more on this?
Yeah, exactly. So like anything else, it helps to visualize it through actual trade examples. So
Yeah.
that was a big part of the purpose of holding the live event, was that we could walk through real scenarios, real trades, where we execute this strategy. So I do urge people to check that out, because we dive a whole lot deeper. But you'll discover the actual strategy. So it's a simple 4 steps. And
Okay.
in fact, for attending the free event, you get a cheat sheet, and that cheat sheet will walk you through the steps and kind of lay the groundwork. So when you register for free, you get that cheat sheet, and it will give you a good kind of baseline knowledge going into the session. So I would urge you to check that out. But it's really just 4 simple steps. It's a very simple trade to execute. It only consists of 2 legs. Okay, so it's not a very complex option strategy. They're just 2 legs, and again, short duration. So we're holding this trade for under 24 hours. If we enter 1 DTE, it's typically towards the latter part of the session prior to the expiration day. If we enter 0 DTE, we're going to typically enter near the market open, near the cash open. Let's see, what else could I tell you? We're using, I think I mentioned this, but we're using the expected move. So this is critical and really should be used in virtually any options trading decision. But we use it in a very unique way to select strike prices for this strategy. So there's no guesswork involved. You always know exactly what strike prices you should be selecting. And these are really exciting trades. So we haven't really touched on
You
the
want to share
potential.
your screen? You want to show us something?
I don't have anything prepared to share screen
Okay.
wise, but um, one thing we didn't really touch on was that uh, the profit potential in these. So
Okay.
these trades have tremendous profit potential, and again, it all ties kind of back into that gamma. It's not unusual to see zero DTE contracts double, triple, quadruple. I've seen days where they go up 1,000%. Um, so we're actually relatively conservative with this strategy. We're targeting 50 to 100% return on investment in under 24 hours. And that's actually a very realistic profit target, but a lot of potential with these. Yeah. And the other thing I'll be covering on this session, this is more advanced and in depth, is our trade adjustments. So like any other strategy or trade, right, there things can go wrong. The market could throw you a curveball. Market conditions could change. So we also go into different ways to adjust this strategy, and we don't have to do it very often, but we've had occasions where we've taken a golden one day options trade that wasn't going as planned, and we executed a very simple adjustment and turned it into a net profitable outcome. So I cover that in detail on the session as
I
well.
was gonna say, when you start talking about those gains in basically a day or overnight trade, the first thing that comes to my mind is, along with those potential gains could be potential losses of the same magnitude. So you've got to have some sort of defensive strategy. So it's not as simple as a stop loss. It sounds like you throw on a couple of additional trades, turn your strategy into a different strategy when you see it going against you. Does that sound right?
Yeah, it does. And I'm glad you brought that up, AJ. So this is a defined risk trade. So you always know your risk up front.
Okay.
So it's not undefined risk. And this is one thing we focus on in the session. When I trade options, I always do what we call sizing for zero. So I never use stop losses. I
Okay.
always size my positions as if they were to go to zero. And a lot of people aren't familiar with that kind of money management tactic or
No, you
position
have to
management
do
tactic.
that. You absolutely have to do that for a lot of
Absolutely.
strategies, because if you
Yep.
don't and you actually think you can bail yourself out, some of these strategies can go from, winner to loser in almost, a split second. And so
Yeah.
yeah,
What's
I'm
that
glad
mean?
you said that.
What's the risk to zero mean?
Yeah,
Oh,
so I'll kind of explain that, and I'll give you an example of the advantage that's embedded in it that a lot of people don't realize. So, well, and we can just keep it simple, like with a call option. So if again, trader A, trader B, so they're both, let's say they both think a stock's going to go up, they both buy a call option, and they predefine their risk. Let's say they're willing to risk $1,000 on the trade. So there's a couple approaches, right? One, trader A could invest $1,000 in that call contract, and if, regardless of what premium they pay for it, say they pay $1 for it, right? If that goes to zero, they lose their $1,000. That's their defined risk. But then trader B, and so let's say they traded 10 contracts, right? Trader B also has defined risk of $1,000. That's their max they're willing to lose on the trade. But they trade 20 contracts. So in order to adhere to that risk, they're going to have to set a stop loss at half the premium, so 50 cents. Again, both traders exposed to the same underlying movement. Let's say that stock, they both get into the trade, the stock pulls back. Okay. Trader B gets stopped out. Trader A is still in the trade, and they haven't exceeded their risk threshold, right? And then all of a sudden the stock reverses and goes back up. Trader B is out of
exactly.
the trade with a loss. Trader A still has the opportunity to profit. We actually did this recently I run a live trade room, and we did this recently with a zero DTE. It wasn't the golden one day options trade. It was another strategy. We were simply just buying a zero DTE call, and we sized for zero. So we, predetermined our risk and invested that into the call contract. This was a very short duration trade. We put it on, I think, like an hour before the cash close. And I'm not remembering what, I think it was on the QQQ. It pulled back, and and again, I don't remember the exact premium we paid for it, but that premium went down to 1 penny. And our thesis didn't change. We still expected the Q to rally going into the cash close, but we didn't use a stop loss because we sized for zero. It went down to a penny, and within the last 5 minutes of the session, right before the cash close, the Qs rallied and we hit our profit target. So sizing for zero allowed us to stay in that trade, even though the premium went down to a penny, and then it rallied, and we had all that gamma working to our advantage right at the cash close, and we hit our profit target. So if we'd used the stop loss, right, then we would have been stopped out. So that's kind of what sizing for zero is.
And also, SIP, sometimes those stop loss orders don't trigger correctly, right? Especially if there's a big move and it's not as liquid as an option, right? So you think that you're protected, and then you find out that, hey, especially on a gap on open or something, that all of a sudden you get stopped out at a much different price. This is why, I've had folks come to me at the end of like events where I've been speaking, and they're like, hey, I've been trading this vertical spread strategy for the last 9 months, and every month I've been making close to double digit returns, and it was going great. And then something happened on month 11, and not only did I lose all the gains I made in the first 10 months, but I also lost half of my starting, and I'm having to mortgage my house, and my wife wants to divorce me. So only sizing the position for the amount of risk that you could lose in the whole position is just it's common sense. But options are so cheap, people get really excited and they decide to go, overextend, and then all of a sudden that's the end of that.
Yeah.
Well, anytime you hear 50 to 100% in 24 to 48 hours, I think people are like, hey,
Let me
what's
throw
the
my whole portfolio at that.
What's the hack? Let me figure it out. But there's a little
Right.
bit more logic to it. I do have another question that comes to mind for me is the zero DTE, and knowing, AJ, that options expire on Friday, does this mean that this is like a Thursday trade? Like Thursday is like the juiciest day because you've got that options
Good
expiration
question.
coming up on Friday, and then like you got weeklies, you got monthlies, you got the triple witchings and stuff. Like, is there some variability to that?
Is that for AJ or for me?
No, that's
That's
for you,
for
Jeff.
you.
That's for you,
Oh,
Jeff.
okay. Yeah, good question. Yeah, it's funny you bring that up because when I started trading options back in the 90s, we only had Friday, monthly expirations. So
Yep.
third Friday of every month, that's all we had. And then of course weeklies come along, and then now we have zero DTE. But yeah, good question. So these actually, so it varies. And interestingly, I think it was last week they just rolled out zero DTEs for a dozen or so new securities. A lot of the mega caps like Amazon and Alphabet now have zero DTEs on Mondays, Wednesdays, and Fridays. So it varies a little bit by asset, and they're not available on every optionable asset, of course. But yeah, these are contracts that will expire on any day of the week potentially, and in some cases, like on the SPY and the Qs, and I do a lot of options on futures, so the ES, the NQ, these expire every day of the week, Monday through Friday. So it's incredible. And one of the big things I alluded to around that is even if you're not trading options, the information these give us is huge. So now we have daily expected moves. So if I'm just trading the underlying stock and there's zero DT options on it, I can use that information to set realistic profit targets and define my risk using expected moves. So,
And this is data that we all have access to, right, Jeff?
exactly, yeah, it's right there in your broker platform, and yeah,
Can you give us a hint on understanding that kind of tool that we never had before, and now it's just everybody's got it in their visualization? Could you kind of give us an idea, not how to like size the position or pick the strike prices, but that expected move measurement? What are you using for that?
yeah, yeah. So, and most broker platforms will provide it in somewhere on the platform. There's a way to estimate it as well. You can just add up the at the money straddle. So you take the strike price closest to the current underlying share price, add up the premium at the offer on the call and the put side. That'll give you a pretty rough estimate of the expected move. And there's a lot of ways to use it. I alluded to one as it relates to just trading the underlying stock or ETF or index. But when trading options, there's a multitude of ways to use it as well. With the Golden Monday options trade, we're using it to select our strike prices. So again, this is a more of a market neutral, non-directional strategy. So we don't care which way the market goes. We have profit potential if the market rallies or if it sells off in the Golden Monday options trade. But we're using that expected move to select our strike prices. And again, I get into all those details and steps inside the webinar event. But yeah, there's a lot of ways to use it. It's remarkably accurate. And I think the important thing to know is that with expected moves, a very small percentage of the time are they not reached. So, and it's in the single digits. I would say probably less than 5% of the time. So a high percentage of the time, we're going to hit that expected move or exceed it. And it's okay if we exceed it, all the better for the Golden One Day options trade. So, yeah.
The Golden One Day options trade.
So the link to that is in the chat. So if anybody wants to head on over there, sign up, get that cheat sheet, get a breakdown of how to go through this. You got a lovely landing page here, Jeff, with some more specific details on what to learn and what you'll get. So head on over there, check out. Tell them AJ sent you, which you probably already know. But Jeff, we do have some more analysis that AJ, that we like to go through the show on a couple names that we've been looking at over the past couple of weeks, past 2 or 3 weeks. And then we do have our speed round. And so we could keep you around if you want to throw some insights and analysis at us, given your, repertoire of knowledge and tools from your end. And then, as always, folks, we are streaming live. So if you guys have any specific questions for Jeff as well, head on over to the chat and, throw your question in there, and we'll see if we can get to it. Otherwise, we're going to take a short break, and we'll be back in a few seconds to review some names from last week. And then, AJ, we've got our speed round, and we'll get some input from Jeff. So sit tight, folks. We'll be back in a jiffy.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right, so I'm going to get AJ's quick links into the chat as well here shortly. That's the commercial that we just had there is AJ's webinar on premium selling. So look, if you want to learn AJ's strategy, we've got some information for you there. If you want to learn Jeff's strategy, we've got some information for you there. Some good stuff to head into Super Bowl weekend. If you're not a football fan, you can go ahead and do some options nerding out. There it is for you. Or if you're like me and you like football and you like options, well, maybe you'll check out both. AJ, starting with some names that we've been looking at over the past couple of weeks. I think Rivian is the one that we've been looking at the most in the past. And I guess we were questioning, could we find a bottom here? And what's your take? Where are we at with this?
So last week we were, in that place where we were wondering, is this going to be a swing trade or is this going to be a trend reversal? We got all of our signals to follow this as a trend reversal. A lot of folks jumped in actually more than a week ago, more like 2 weeks ago. And so it's actually worked out quite well, dropping from 17 down to 14 people with their leveraged option or out of the money option. Some folks were going ahead and trading their out of the money option, have been doing very, very well on this one, Sip. So it turned out, to be that trend reversal that we thought of. Remember, we were at that kind of pivot point as to what way it would go. We're talking trend reversal going into the earnings here. So a lot of people are liquidating their position now or putting a collar on in order to protect themselves should something go on with earnings. And also, folks, I've been hearing that some folks are putting their calendar spreads on. Now, I'm not sure I would condone that simply because, with the calendar spread play before and after earnings, you really don't want any expected price action. And if we zoom out a little bit here, Rivian tends to have some price action. Well, it's 50-50, but they tend, if you look at the historical moves after earnings, there's some price action. And with what's been happening in the market, I'm not sure I'm going to be doing any of those calendar spreads on Rivian this year.
I guess my question for you, Jeff, is with knowing that earnings is a couple days out, how do you
Oh yeah,
think
how does
about,
that affect the golden
how do you
one-day
think
trade?
Great question. So I largely do the Golden Monday options trade on index products like the SPY, the Qs, but it could certainly be done on an individual stock. And this is one of the critical details, and really is applicable to any option strategy, that we go into depth on the event, and that's implied volatility. So, of course, as earnings is coming up, implied volatility increases,
Mhm.
and then after the earnings announcement is made, right? I call it a known unknown event. We know it's coming up. We don't know what the results or the market reaction is going to be. You get vol crush, right? Volatility drops off a cliff. So this strategy benefits from an increase in volatility, and so if you were going to use the Golden Monday option trade, you could do it going up into earnings.
But you wouldn't do it through earnings.
Correct. Exactly.
Makes sense. Totally makes sense.
Yeah.
All right, so that's kind of where we're at with Rivian, name we've been looking at a couple weeks. Didn't really work out the way that we wanted, but sometimes that happens. The next name that we've been eyeing, this was our pick last week, is Bank of America, which I can ticker symbol BAC, which I think you put BANC. Which I can only imagine is being affected by this pullback, but it looks like it's already rallied a little bit here. AJ, where are you at with Bank of America?
So Bank of America was one of our swing trade setups, and it absolutely performed exactly like we thought it was. We're, again, looking for where that exit's going to be. And when I say exit, a lot of our traders are not necessarily exiting out of the position, but instead doing a collar. So that means when it tops out, they're selling some premium just above that. So whatever strike is just above that, they're selling that premium and then using those proceeds to subsidize an option below, kind of a risk defined, and then just collaring it right there so that whatever happens, we know exactly where we can start seeing a max risk, and anything below that, that protective option, in this case, a protective put, is going to offset the basically make the risk stop to zero until we start moving back up. So there's a lot of folks who are looking for where they can install that collar, and other folks are just going to take the initial position right off, take the profits, and move on to something else. So that's where we are with Bank of America. It played out just the way we wanted it to.
So basically, you could either take some of your profit now and or hold on to it to see if you can extend that with that option that has, some sort of date, what, maybe 2 weeks out, or what would you
So
look
the
at?
premium option that we use to subsidize the protective option usually is, either the next monthly, or in the case of Bank of America, there's enough liquidity on the weeklies, 3 to 5 weeks out at the most, maybe 2 weeks out. That protective option, we usually go farther out in time, 3 to 6 months out. So that gives us a longer amount of time. We kind of counteract the changes that have, like Jeff was mentioning, all the heavy trading and the volatile, the buying and selling pressures is on those ones that are near term. So when you go 3 to 6 months out, you kind of buffer that kind of, how the volatility or implied volatilities affect the price of an option 3 to 6 months. You also kind of blunt the effect of theta decay, right? So we can use that option 3 to 6 months as our protective option. So again, in this case, we would be selling maybe, where it tops out. If it's the $58, $60 call, we would sell that guy and then perhaps buy, depending on where you want to lock in your profit, buy a $55 put that's not going to expire maybe till June.
But AJ, in theory, you're saying that the volatility and us being in earnings season is encouraging you to step away a little bit more from some of these swing trades that maybe you might have looked at in Q4 of last year.
Well, that's exactly right. So this was one of those ones. It's in the banking industry. Remember, banks report they're in the first week of earnings season, so Bank of America already reported in the rearview mirror. But yeah, there's a lot of volatility going on, and the majority of us are selling premium. We were just looking at this trade and Rivian as possible swing trades, and we were paying attention to see if they turn into trend reversal trades. So Rivian went trend reversal on us, so we traded it in the opposite direction. Bank of America did the swing trade pattern. So again, waiting for that lagging indicator to tell us what to do and then just playing the trade out. These are more directional strategies, Sip. But yeah, not many of these in play for us right now. Mainly, we're in the business of selling premium on those ones that are in sideways chop patterns.
And Jeff, I agree. I assume you agree with everything AJ just said there.
Yeah, I do. Yeah, interestingly, I used to do a lot of collars. I did a lot of diagonal collars.
Yeah.
And yeah, it's a great strategy.
Yep. Thank
Awesome.
you.
So
But
that
now, what about do you guys do your goal? Again, I'm so curious. I'm going to have to go and sign up for your webinar. But are you doing any of that on like an ETF, like a sector ETF?
We have done them on sector ETFs. Yep. Yeah, really anything that has a zero DTE, and of course,
Yeah.
even if the security just has weekly options, you could do those on a Friday, right? And it's still essentially a zero DTE. But yeah, we do them on sector ETFs as well. Yeah.
Neat, man. It sounds really you've wet my palate big time.
Good.
well, I heard 50 to 100%. So I've been listening and paying attention this whole time.
Yeah.
All right, AJ, moving on. We got a speed round here. So we've got 3 names.
Okay, these are our user picks.
These are our user picks from our lovely folks all across the country. And I'm very excited to hear about this first name because we've talked about this for a couple months now. And I actually made the move on it a couple months ago. But Kelly out of San Francisco, California wants to know, AJ, do we have a play in Lyft, the rideshare hailing app, ticker symbol LYFT? Lyft, AJ, what do you got for us?
Actually, I want to punt over to Jeff. What are you thinking, Jeff? And then I'll give my 2 cents. Do you have any thoughts when you see Lyft or hear about Lyft? Go ahead.
Yeah, I mean, obviously the stock's gotten hammered pretty hard since the prior quarterly earnings back in November, and it was previously in a strong uptrend, of course, and so it's a pretty obvious trend reversal from prior quarterly earnings. What I like to pay attention to is because what often happens is, right, you get a top and bottom line earnings beat, but the stock can still sell off, right? It's largely the forward guidance that the market's focused on. And so I'd be interested to see kind of which direction the stock gaps, and you tend to get post earnings follow through on those gap moves, but they can also reverse it. Like if we're looking at the prior quarterly earnings, right, you get a pretty strong rally to the upside, and then a equally swift rotation back to the downside. So it's definitely volatile, but I guess we'll, to be determined, but the stock is definitely in a downtrend. And I would look, it looks like kind of right around that 19 handle is where prior support turn resistance resides. So I think, if the stock can recover back above the 19 handle, then I think from there it's probably some more significant upside potential.
That's what I'm thinking as well. So number one, I'm not sure what Kelly's wondering here by submitting this pick. Again, with that volatility crush play on the calendar spread, remember, we don't want to, we want to have a lot of confidence that price action's not going to be that far, or that we have a bias and can put that calendar spread in the direction of the bias. Kelly, I got to tell you, just like I am with Rivian, I'm kind of staying away from this earnings play on Lyft. I think that there's so much, unexpected stuff going on, a lot of uncertainty, that I think we let earnings go through, right? And this is just my suggestion. You don't try to trade that unless you're trading up to it and you're in and out before earnings is even released. That's a whole different animal. And then maybe you're thinking that it's at a bottom, but I don't see I'm going to throw some of even my faster lagging indicators on there, and see. But I don't think you can say that this is yeah, I'm not getting any of my signals. Let this thing find a bottom, and I would say, get through earnings. Let this thing find a bottom and use a real lagging indicator. So it may be a few days after the actual bottom's found that your indicator confirms that, but you don't want to get any false because there's downward pressure right now. So I don't want you to. I can actually almost imagine that you're like, when do I start buying lift? When is it low enough? Let's wait, and like Jeff said, it's maybe even better, let it get above that level of, already tested support and resistance before we start thinking about, getting back into this. Even if you wanna have a holding position, a covering position, and then start selling premium against it, I don't think you wanna do it now. I think you kinda wanna just watch this one.
I'd be curious what their speed of getting into the autonomous driving is, just because I know that Uber's mentioned it. I know Tesla's getting ready to roll it out, and I see so many Waymos every day. I'm just like autonomous driving is here, and people are hailing them, and I could see Lyft kind of playing catch up rather quickly, being kind of the second rideshare company. So that's an earnings call I might actually want to get some clips on. So
You
thank you
might.
for that insight. Moving on to our second name. Oil's been a hot topic this week. Now, this isn't oil particularly, but Michelle out of Austin, Texas wants to know, do we have any correlation or a play in Halliburton, ticker symbol HAL, which I believe we touched on a couple weeks ago.
Yeah. We touched on it because we had a leading indicator. Oh, I'm jumping ahead of Jeff. Jeff, give me a second. It's just on the tip of my
Yeah.
tongue. We had our leading indicator. I think we used both the slow stochastics and the Williams percent R. They both agreed that, hey, things were extremely oversold, and then we saw our swing up. But I don't think that that's the case right now. I know that you might think that there's pullback, but if we were to just throw one of these leading indicators on there, like the Williams percent R, and I always like to, I don't know, that's the 10 is more of a day trader thing. Whenever I've gotten with Larry, he's always like, change it to 14, change it to 14. Okay. So yeah, I want to see it not only, the standard place they put these lines is 80, but I'm going to actually drop it down to 90. When I'm looking for something to have enough pullback, I want to get it to an extremely oversold position, and then I want to see I don't want to actually trade it until the lagging indicator comes in and says, okay, there's been a reversal, right? So I see you might be using this lagging indicator, and you're like, hey, maybe it's time to go long on this. I don't think I'd do that. I hate buying high and hoping it goes higher, right? I like to buy low, sell high. So I'm gonna again say, and Halliburton's already gone through earnings, so you missed any sort of opportunity there. I'm gonna say just watch this thing, look for more pullback, look for opportunities, where it might flatten out and start getting choppy on you, where you could leg into premium selling positions, leg on and off with some collars. But right now, I don't want you to get in high and then go higher. That's my 2 cents on that. What do you
Jeff,
think, Jeff?
you're quick.
Yeah. Yeah. Well, certainly, just from a technical perspective, the stock's in a well-defined uptrend. I agree with AJ. It's also in consolidation right now, and I guess the thing that I would notice is it's held current levels post earnings, but it hasn't really rallied significantly post earnings. So that's something to kind of be aware of. Probably pullback opportunities are more appropriate. And although we don't have one on the chart, I can kind of visualize where the trend line support is. And that looks like it's probably going to be down, closer to like the 30 handle or so, maybe 32, but so a pullback maybe somewhere in that neighborhood. it looks like there's some, horizontal price resistance now serving as support down closer to 30, maybe the 28 to 30 handle as well. So I would maybe watch for pullbacks into that zone. And then, of course, reference price action around those levels. If they hold and the stock catches a bid, gets a bid under it from there, I think that could be a good opportunity to go long.
Now, when you see, I hate to jump in here, Sip, during the speed round. I know we're trying to get through these, but I want to quiz Jeff here because again, I'm so excited about joining his webinar and learning more about this. When you see this consolidation like this, is this something that would, pique your interest for one of those 0 DT trades on a weekly option, or is that against? Like, I'm trying to figure out what sort of, if I was to create a screener, or by the way, do you guys offer a screener, or how do you? Okay, too many questions at once.
No,
I'm
no,
sorry,
it's
Jeff. I
okay.
got
It's
excited.
okay.
Let's start with the first one. Is this a type of pattern you look for or you stay away from?
Yeah, so I'm glad you asked that because interestingly, you can do the golden 1-day options trade without even referencing a stock chart.
Okay.
You don't even need a chart, but we do incorporate some technical chart analysis into the strategy because it can give us a bit of an extra edge. And essentially, what we're looking for is range expansion, which of course often correlates with volatility expansion. So, in other words, when you have more narrow daily high-low ranges, so just taking the high and low of the day, you want to look for an expansion. So where the high-low range is widening relative to prior days. But to answer your question, it can work in during consolidation. It can work in breakouts. So really all the above. But yeah, I would say when you get consolidation in the context of an uptrend, and the longer that goes, generally the more explosive move you're going to get. It tends to be to the upside if there's already an uptrend intact. But if it breaks down, it tends to be a more dramatic rotation lower. So,
And then I guess the watch list. Do you help with identifying these at the end of the DTE? Is that part of the cheat sheet? I would assume something like that.
Yeah. Yep. Yeah. So that's pretty subjective, right? We have members who trade them on individual stocks. I just keep a very small watch list. I mainly do them on the SPY, the Qs, and there's really, even just on those two tickers, there's ample opportunities to trade the strategy. So,
And you said also futures. You do options on futures.
I do, yeah, and I love options on futures because you get the exposure to the overnight sessions, right? So the options on the futures, of course, trade around the clock with the futures contract. And the nice thing about using that investment vehicle is you can put the trade on 1 DTE and then of course take advantage of the overnight exposure. And so often I'll put them on day prior to expiration and I can hit profit targets while I'm catching some Z's overnight. So yeah, it's an advantage for sure.
That's AJ's favorite strategy is making money while he sleeps.
Exactly.
I do like that.
Who doesn't like to do that?
All right, AJ, we got speed with our final name, Frank out of Tacoma, Washington, one of our popular go-to super boring names, HPQ. What do we got here?
Consolidation as well. Frank, you're probably wondering that you're probably seeing this and wondering, do I have a bottom? Again, this is downtrending. This is not in a sideways channel. So I'm not a fan of you thinking that, hey, you want to go long on this. Plus, it's been stalled for about a week and a half now. But Jeff, I'm seeing expanded. Am I seeing the pattern that you might be thinking is a better pattern for the 0 to DTE on this?
Yeah. So like where you have your up arrow, the most recent up arrow there.
Yeah.
Looks like in January maybe. You can see that there's range contraction. So pretty narrow high-low ranges. And then as you move to the right, you're getting range expansion. Got a gap down and then range expansion. So yeah, that's one of the things we like to look for when we do the golden 1-day options trade.
Guys, you everybody who's watching and me, we need to go sign up and pay attention to this webinar. It sounds really juicy.
Yeah, so with that, let's go ahead and give everyone a quick overview once again. Jeff, thank you for joining us. This is his golden one-day options trade. A lot of juicy, unique approaches to utilizing a potential unique trade. I think, AJ, we've been running the show for like 3 years, and I think this is the first time where we've kind of heard this approach. So very unique. The link to access this is in the chat, so head on over there and sign up. And with that, Jeff, any final words of wisdom to the audience out there?
Well, first of all, I just want to thank you for having me. It was a pleasure to be here. It's really enjoyed it. And yeah, as far as words of wisdom, trade small, is always what I tell people. Don't over leverage, especially right now. Use defined risk strategies. And it's going to be an interesting February, I think, with markets overextended to the upside, and a long time since we've had any sort of a real correction. And I think there's just a lot of downside risk in markets. Yeah,
it's time.
It's time.
Which is the best opportunity to utilize this wonderful options tool. So thank you, Jeff, for your time today. Thank you for joining us again. The link to all Jeff's stuff is in the chat. Head on over there. Jeff, enjoy the weekend, enjoy the Super Bowl, and stay warm, I guess. If you're somewhere cold, I don't know. It's warm by me, but AJ's been freezing the past.
Oh my God, I'm in Washington D.C., Jeff, and Washington D.C. has been under a sheet of ice for like the last 2 weeks.
I've heard. Yeah, I'm in Boise, and we've had an unusually warm winter.
Yeah.
In fact, record-breaking, since it hasn't been this warm since I think the 1930s. So almost 100 years we've broken a record. No snow. So yeah, I'm kind of liking it, but I'm worried about the snowpack and all the farmers and all that. So
yeah, the summer. Yeah. What about watering? That's interesting.
Yeah.
All right, Jeff. Appreciate it. Have a good weekend. We'll talk to you soon.
You as well. Thanks for having me. Take care.
All right. Once again,
that was pretty cool.
I love it when there's definitely two guys that are incredibly intelligent talking about some complex stuff, and I'm just trying to keep up. But I like the Swiss Army knife of trades, right? You've mentioned it many times in the past.
Yeah.
28 different ways to trade options, or now there's even more.
This is a good one.
And so
with all the new, options that are expiring every day, that's an interesting play he's got there.
All right, AJ, looks like we've reached the end of our show. Big thanks to our guest, Jeff at Altos Trading. Go and check out that one-day golden one-day options trade. If you want access to AJ's, let's go ahead and get your quick links page in there as well. We've got AJ's quick links in the chat as well. Go ahead and show some love on those socials. Hit that like, hit that follow, hit that subscribe button. Head on over to the indicator suite. Get those juicy items before we start to charge more for them. Head on over there, get them added to your trading stations. Check out the webinar if you're new to options, or if you're interested in learning more about premium selling. We've got a wonderful option to get the ball rolling for you. You can become a member of Trading Trainer at any time as well. You can head on over here to learn more about the program, and then, as always, custom coaching. So if investing and putting your money to work is something that you want to be a little bit more serious, a little bit more hands-on with, we have an option here that is custom coaching. So the link to that is in the chat. Head on over there. AJ, the Super Bowl is this weekend. Will you be watching?
Yeah, Bad Bunny, man.
So you're watching the halftime show?
No, we're actually hosting a Super Bowl party here. So we've got our a little, we've got a little viewing area that people will be watching, and of course AJ will be behind the bar in his AJ's lounge serving drinks, because that's one of my favorite things to do for my peers. And then paying attention to the halftime show. I can't wait.
And then, so are you? I'm assuming because you're East
Seahawks.
Coast, you're rooting for the Seahawks?
Yeah.
I think I am too, just because I don't really like the Patriots have had their run. They don't need
The
they don't need
Patriots
another
have been
Super
there.
Bowl.
I think, but are the Patriots well predictive markets, right? So who's
It's
coming
the
out ahead?
Seahawks. The
Yeah,
Seahawks
yeah.
by a
I
hefty
think that
margin, like 4.5 is kind of the spread right now.
won't that be an upset though if the Patriots wind up winning again?
Yeah, I keep reading
Been
that
a
it's the
while
low.
since the Seahawks have been in the Super Bowl.
Yeah, I think like the early 2000s, something like that,
Yeah.
with beast mode and all that. But
Mm.
always an exciting time, just in terms of what's going to happen, the commercials and things like that. So
Nachos.
whoever you're rooting for, please enjoy our favorite all-American sport, American football, where they usually throw the ball and not so much kick it, but we call it football for some reason. Big shout out to our guest, Jeff, for joining us. Big thanks there. AJ, thank you again, as always, for all your time. And thank you to the lovely folks out there for joining us. We appreciate it. That's all I got. Enjoy the weekend, everybody. Stay safe.
Take care.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.